welcome to Main Street Macro. I'm Neela Richardson. Have you ever returned to a familiar place after a long absence, only to find that it's changed a great deal since you last visited it? Well, the same can be said for the economy. Soon the jobs market will return to pre-pandemic levels, and the economy is closing in on its former growth trajectory. But as the economy speeds back to the place it left off in 2019, it's not quite like it was before. It's a lot more expensive. Inflation rose to 8.5% in March, hanging on to a 40-year high. Yet the market reaction was a little muted. Many market watchers are expecting this to be the peak inflation month. However, Main Street is likely to have an altogether different reaction. Here are the top 3 responses of Main Street to higher inflation. Reaction 1, I'm priced out. We get 2 important reads on the housing market this week, housing starts and existing home sales, all of which will say the same thing. Home prices are high. They're actually growing double digits. Home prices are up 33% in the past 2 years, mainly due to record low inventory. But mortgage rates are also going up, rising at the fastest pace over the last 3 months in nearly 30 years. The rate on a 30-year mortgage is now 4.7%. This is up from 3.2% at the beginning of the year. But what happens in the housing market doesn't always stay there. High prices also affect apartment rentals by adding to rental demand and by limiting rental inventory. In fact, vacancy rates for rentals dropped to 5.6% at the end of last year. This was the lowest rate in nearly 4 decades, and incidentally, inflation was high at that time too. Main Street reaction number 2, what happened to my raise? While nominal wages have accelerated over the last year, real wages, when we take into account inflation, have actually slid backwards. Real wages 2 years ago, when inflation was low, were ahead of the game. They were up over 2.5% for the typical worker. Real wages now are sliding back by 3%, even though take-home pay looks higher. Main Street reaction number 3. But hasn't inflation peaked? That's what I hear on the news. Well, inflation is thought to have peaked this month, according to a lot of economists and analysts. Supply chain bottlenecks are easing, pandemic disruptions are fewer, used car prices, which shot up during the pandemic, have finally come back to earth, and more people are back in the labor market. That's reducing absenteeism and its effect on the economy. But prices aren't going to go back down to 2019 levels, even if their growth rate slows. It's prices that will still be high. And going back to housing, since rental contracts are actually annual, housing's full impact in terms of inflation won't likely show up until later this year, sometime after the government data says inflation has peaked. All of these 3 reactions on Main Street mean one crucial thing. The new normal in the economy costs a lot more. Thanks for watching the Main Street Macro. For more information on the week ahead and what the return to normal means for Main Street, go to adpri.org.